Welcome back everyone, and in this video, we are going over 4 of the top dividend ETFs on the market right now. These ETFs offer excellent diversification to a variety of stocks for a very low cost. And the funds we're going over in today's video have different investing strategies and focus on multiple areas of the dividend market. We are going to analyze ETFs focused on long-term dividend growth and others who provide investors with high current income. And dividend investing is one of the purest forms of passive income. Once you make your initial investment, you can sit back and collect your quarterly cash flow. And with dividend ETFs, the entire process only gets easier because all of these funds hold a bunch of different companies, so you never have to worry about 1 or 2 dividend cuts impacting your overall portfolio. And now before we jump into the first dividend ETF, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button and subscribe for those daily videos. And now we're going to take a look at the first dividend ETF in this video, which is iShares Core Dividend Growth Fund. Ticker DGRO currently trades for around $46 per share, and over the past 5 years, the fund has grown more than 93%. So beautiful long-term and consistent growth from this dividend fund. And taking a look, the current dividend yield is at 2.37%, and the expense ratio is very low at only 0.08% per year. In this fund, ticker DGRO is focused on low-cost exposure to US stocks that are focused on long-term dividend growth. So the yield isn't extremely high at around 2.35% at this current level, but over the long term, these are the companies who have a strong history of a sustainable and growing dividend each and every year, and the fund is broadly diversified across many different sectors. And if we take a look at the performance, the average annual return is at 14.5% over the past 5 years. And since the fund's inception, it is averaging close to 12% per year growth over the longer term. So if you're the investor that wants to focus on core dividend companies that will also provide you growing income over the long term, this is definitely a fund to take a look at. And over the past 5 years, a $10,000 investment back in February of 2016 has now grown in this fund to over $21,000. So your capital has more than doubled in a 5-year span, plus you continue to collect that quarterly dividend income. And if we take a look, this portfolio holds 392 companies, so very broadly diversified, and all of this exposure comes at a very low, only 0.08% expense ratio. And that is so tiny that you'll barely even notice it off of your total return. And if we take a look at the top holdings in this fund, we have Microsoft, JP Morgan Chase, Apple, Johnson & Johnson, and Verizon. And these top 5 holdings are different types of dividend growth companies. We have Verizon, who has a high current yield but provides slower dividend growth. Then we have a company like Apple, who yields less than 1% but grows their dividend every year, averaging more than 10%. And we also have a company like Johnson & Johnson, who's in the middle, which averages between 2 to 3% current dividend yield, but has been growing it for more than 60 years, making them a dividend king. So even the top holdings in this fund are diversified across many different types of strong dividend growth companies. And if we take a look at the sector diversification, information technology makes up around 21%, financials come in at just below 20%, healthcare at 16%, industrials around 12%, consumers make up around 15% of the fund in total, some utilities, some communications, and some materials round out the remaining fund. So as a whole, you're getting a ton of sector diversification, and not one sector is really above that 20% weighting of the overall portfolio, which I am a big fan of. So definitely take a look at DGRO for one of the top dividend ETFs on the market right now for both share price appreciation and a nice 2.4% current yield that will consistently grow over the long term. And now if we move on to the second dividend ETF we're going to analyze today, we have ticker SCHD, which is Schwab's US Dividend Equity ETF. It currently trades for around $67 per share, and over the past 5 years, it has grown by more than 83%. It has a current dividend yield above 3% and pays out quarterly. And the expense ratio on this fund comes in at a mere 0.06%, again, which is extremely low. And this fund tracks the Dow Jones US Dividend 100 Index. It provides a low-cost, diversified, and tax-efficient portfolio of dividend-paying companies. And to be included in this index, it focuses on quality and the sustainability of that dividend payment. So it takes a look at the financials of the company and ensures that over the long term, the business can afford and grow that dividend as time goes on. And it invests in stocks that have fundamental strengths relative to their peers in the same industries. So it picks the leaders of the market and is not as broadly diversified as some other funds we're going to go over today. And taking a look, the annualized return for this fund over the past 5 years is at 14.5%. And since its inception, it has grown by under 14% per year. So definitely a ton of returns coming from this overall ETF. And taking a look at the current yield of 3.15%, it is definitely at an attractive level at this point in time. And taking a look, some of the top holdings include ExxonMobil, Texas Instruments, 3M, Altria, and UPS. And right away, we can see that the top 5 holdings in this ETF are very different than DGRO, the first fund that we already looked at. This one focuses on more higher yield companies that are the leaders in their respective industries, and DGRO was focused on long-term income growth with some smaller yield companies in the top 5 holdings. So that just shows, although these are both dividend ETFs, they have different focuses and are investing heavily in different companies. So even if you own 1 or 2 diversified dividend ETFs, you can still get mass exposure to many different companies overall across the entire market. And if we take a look at the sector diversification, we have financials at 25%, industrials at around 18%, consumer staples at 16%, and information technology makes up less than 14%. And another point that I want to share is that this Schwab Dividend Equity Fund owns 102 different companies. Compare that to DGRO, the first ETF that we looked at, which holds 392. So we can see that the Schwab Fund is more selective with the investment it makes, and it focuses on the leader within each sector that provide consistent and growing income. And that just shows that not all dividend ETFs are created equally, and you actually have to understand how the fund invests in order to choose what is best for your personal strategy. So definitely take a look at ticker SCHD. It's one of the largest and most popular dividend equity ETFs on the market right now, which has a different strategy compared to DGRO, the first fund that we took a look at. And now if we move on to the third dividend ETF on the market right now, there's ticker VIG, which is Vanguard's Dividend Appreciation Fund. It currently trades for $143, and over the past 5 years, it has grown by more than 96%. It has over $54 billion of assets under management, making it one of the largest ETFs in the dividend space. Its current yield is at a very small 1.6%, and the expense ratio comes in at a very small 0.06%. And this ETF tracks the NASDAQ US Dividend Achievers Select Index, which provides a diversified portfolio of assets that focus on long-term dividend growth, similar to DGRO. And if we take a look at this current level, a $10,000 investment made 10 years ago into this fund has now grown to more than $31,000. So your initial investment has tripled over the past 10 years by owning ticker VIG. And right now, this portfolio is made up of 212 companies and has over $64 billion of total net assets. And the top 10 holdings include Microsoft, Walmart, Procter & Gamble, Johnson & Johnson, Visa, United Health, Disney, Home Depot, Comcast, and Oracle. And of course, Disney has suspended their dividend, so I'm sure they will be bumped out of the top 10 holdings after the next update. And going forward, we can see the consumer discretionary makes up over 22% of this fund. We have industrials coming in at just above 20%. We have healthcare at below 15%, consumer staples at 10%, and technology at only 12.5% of this overall fund. So we can see again, DGRO had close to 400 holdings. Schwab had 102, and VIG has 212. So already, all 3 funds that we're taking a look at own different companies in their top 10 holdings. They own a different variety of companies and provide different sector exposure. So you really have to do your research and understand what you think is the best option for your personal portfolio. And taking a look at the average annual performance, we can see that VIG over the past 5 years is averaging close to 14.8% growth, and over the past 10 years, it is averaging around 12.2% overall return, and since its inception back 15 plus years ago, it's averaging more than 9% overall growth from this nicely diversified ETF. Vanguard is the leader in the low-cost ETF space and are one of the top asset managers on the planet. They have a strong reputation, they have a beautiful platform, and overall, for some long-term, beautiful, broad-based ETFs, Vanguard always provides some low-cost alternatives. And now moving forward, away from Vanguard and into the fourth stock and dividend ETF we're going to take a look at today, we have ticker SPYD, which is an S&P 500 high dividend ETF. So this provides a high current yield, but lacks the capital appreciation that the first three ETFs provided. Over the past 5 years, this fund has only returned 30% in share price growth compared to all the other ones we've taken a look at, which are at 85+%. So you can see already, you're trading that long-term share price growth for some high current income. And the yield on SPYD is at over 4.5%. So if you're at the closer stage to retirement and you need that income right now and you're willing to give up the long-term capital appreciation, then definitely take a look at this ETF. For a very low fee of only 0.07%, you can collect some very high quarterly cash flow. And this fund gives you exposure to the top 80 high dividend yielding companies within the S&P 500. So of all the large cap companies in the market, you're getting exposure to the top 80 highest yielding names. So if you need that high current income, this is a great low cost alternative with an over 4.5% dividend yield at this current level. And you're only paying a 0.07% fee, and you don't have to worry about reading any financial statements. You don't have to worry about tracking each individual holding. You can hold this ETF and just collect that quarterly cash flow as time goes on. And over the past 5 years, the average annual return from this ETF is around 8.2%. So that just shows you can still collect some high dividend income and your overall portfolio will grow at a decent rate year over year. And if we take a look at some of the top holdings, we have Seagate Technology, Hanes Brands, Hewlett Packard, and Simon Property Group making up the top 4. And the largest holdings in this ETF make up less than 1.5% and just shows the broad-based diversification across all 80 top names. And the fund is broken down into a couple core sectors that include financials, real estate, energy, and utilities. And all the other sectors in the previous 3 ETFs, such as tech, consumers, and healthcare, which really made up a majority of those funds, only make up a smaller portion of this higher dividend income producing ETF. So in this video today, we definitely took a look at a ton of different investing options. We have investments focused on dividend growth, sustainability, long-term selective picking of dividend-paying companies, and also some higher income. So definitely take a look at each of these funds when doing your research and pick the one that best suits your personal investing strategy. Whether you need the income up front, if you're okay with an average 2 to 3% yield, or if you want to take a lower current yield with longer-term share price capital appreciation. So definitely a ton of different options on the market right now, all provide investors with a nice diversified portfolio of income producing assets at a very low cost. So thank you for watching, everyone. I am the Gen Z Investor. I post videos every single day about the stock market, so please hit that like button and subscribe, and I will see you in tomorrow's video.